Today we're going to talk about why you want to pair trade stocks. So without further ado, let's get into it. Cutting to the quick and getting straight to the heart of the matter. Are you interested in a trading system that can be easily learned, has a multi-decade track record of success, can help you deliver consistent trading income month in, month out, works in most market conditions, and can protect you from a large drawdown? I would also add that if you use our platform and follow the automatic signals generated by it, you can trade and manage this strategy in under 1 hour a day once you've learned your craft. Okay, so what is pair trading anyway? Pair trading involves simultaneously entering long, that is buying, and entering short, that is short selling, two paired securities. These need to be very similar. Securities like IBM and VMware, or Coke and Pepsi, is one possible pair that's used all the time as an example. However, you need to do deep analysis to pick the right ones. This trading strategy is widely used by investment professionals due to its proven success. Investment managers love its controlled risk, low correlation to market averages, and the ability to generate significant and consistent returns. Here you have a bar chart from Barclay Hedge showing for the last 10 and a bit years what the assets under management of all equity long-short strategies are in the world. And that's gone up to $225 billion at its zenith and is still around $170 billion. Now, not all of these long-short strategies are the type of quasi-statistical arbitrage of U.S. equities that we're talking about in our strategy here. But our type of pair trading strategy is definitely subsumed into this category. So the strategy was originally credited to Alfred Winslow Jones. He's an Australian immigrant to the USA. He was educated at Harvard and Columbia and was the founder of the first hedge fund, A.W. Jones and Company. So what was Jones' approach? Jones married two speculative tools to create what he considered a conservative investment scheme. Interesting, he considered it conservative. First off, he used leverage to buy long more value of shares than his initial capital, and he would simultaneously short sell an equivalent amount to avoid market risk. And both of those techniques are traditionally thought of as being aggressive, leverage and short selling. However, when they're done in this manner, can be considered, in some senses, as a conservative investment scheme. If you have $10 million, you buy long $10 million worth of equities, and you sell short another $10 million of equities. So market-wide moves up or down would be a wash. That's if the shares that are sold short and bought long perform in the same manner. The crucial question then would not be the direction of the market, because if it goes up, the portfolio P&L should stay neutral. And if it goes down, it should also stay neutral. But whether the manager had picked the right stocks to buy and sell, because you want the longs to do better than the shorts. And that's how long-short equity trading was originally crafted by Jones, and is still in use today by many different hedge funds. How did he do? Well, for the first 5 years, 1960 to 65, Jones' fund returned more than 325%, despite a 20% management incentive fee. On a 10-year basis, Jones's hedge fund delivered 670% net return to investors. Importantly, that's after fees. Without the fees, it was probably more like 8 or 9 times investors' capital on a 10-year basis. Here's a chart we dug up from way back when. And you can see sort of 59 to 65 how his fund performed. So from that extraordinary start by Alfred Jones and his hedge fund, many people have come to terms with this strategy and started their own hedge funds and developed it very successfully. Tartaglia and Shaw at Morgan Stanley during the 80s were making upwards of $50 million a year. David Shaw spun out of that and then created his own fund, D.E. Shaw. But there's something that a lot of people don't know, and that's that the largest hedge fund in the world uses pair trading. The late, great Jim Simons of Renaissance Technologies testified to the U.S. Congress in November 2008 that his fund uses a stock pair trading strategy. You can listen to this testimony. It's on our YouTube channel, PairTrade Finder, YouTube, and just type in, what is the best trading strategy? And he talks about their in-house fund called the Medallion Fund. This fund used to be open to outside investor capital. Now it's just for themselves. The Medallion Fund is famed for the best record in investing history, returning more than 66% annualized. Sorry, that's before fees. And then 39% per year after fees. These fees were upward of 30% to 40%. Performance fees per year. And it did this 66% annualized over a 30-year span from 88 to 2018. Let's just understand that compounding, that rate of return. If you put a buck with the Medallion Fund in 1988, in 2018, that $1 was worth over $4 million. Do we have your attention yet? This is serious stuff. How about the online trader? Here's a quote that I want to read to you from Chris Stone, Investopedia. I think it says something that all of us, deep down, kind of know, which is it's rarely in the best interest of investment bankers and mutual fund managers or hedge fund managers to share profitable trading strategies with the public. So the pairs trade remained a secret of the pros and a few deft individuals until the advent of the internet. Recent studies, which we highlight on the last slide, show that this trading style continues to deliver superior returns with lower risk, especially in volatile markets. However, now it's not just the institutions. Let's talk about the internet, and let's talk about the advancements in computer power and trading software platforms like the one we sell, PairTrade Finder. Cheap, real-time market data, low online brokerage commissions, and now we're talking zero online brokerage commissions, and cheap leverage available for the retail trader, like the leverage available through CFDs in Europe has leveled the playing field. And elsewhere, you can't get those in the US, but you can look at options trading. But even with portfolio margin, with IB, you can get maybe 4-to-1 leverage, which is more than enough. Listen, the one thing that retail traders have versus the institutions is their small size. We can trade in and out of positions that they just can't because they'll move the market, and we need to learn to use that to profit. Why does it work? Well, contrary to popular belief, a form of logic does run through the world stock market. Most of the time, stocks are priced efficiently. That is, all information is discounted in a logical relative manner. However, every now and then, the market does something unexpected and creates an inefficiency or an anomaly. Stocks trade like schools of fish. Look for an outlier. So this is the way all stocks are moving. And all of a sudden, one stock, or fish in this case, starts moving away from this school. There's a very reasonable expectation that he will head back into the school of fish because that's the way they tend to move. So stocks, why do we get these inefficiencies of these anomalies? Stocks don't buy and sell themselves. Those orders are entered by people, and people are driven by emotions, and emotions cause irrational decisions. And this emotional decision-making characteristic is multiplied exponentially when it comes to crowds of people. As we can see here on stock exchange floors, when you have big reactions to news, which may or may not have any fundamental bearing on the valuation of equities. For example, it wasn't too long ago, I think it was about 3 years ago, that the averages dropped 10% in the space of about 3 days. And then 3 days later, they were back to where they started. So, that type of emotional seesaw is what's creating these anomalies. What I'd add is that we have these massive, high-frequency traders involved in the market now. And anytime they see a major move in a stock, they begin to introduce waterfalls of high-frequency trading orders, which oftentimes exacerbate the move itself. And so, you've got a fundamental dislocation between where one share price may have gone relative to a highly correlated and co-integrated other share that you can pair it with. So if for no good or explainable reason, such as news affecting fundamentals, two highly correlated and co-integrated stocks is very important. For example, let's take an example here, the stocks IBM and VMware. Let's say they diverge away from each other. There's an inefficiency created and an opportunity to profit. Now that you've identified the divergence, or anomaly mispricing, in the relative performance of two correlated and co-integrated shares like IBM and VMware. How do we enter a pair trade? Very simply, we buy long the relatively weaker share of the pair, that is the long leg, and we sell short the relatively stronger share of the pair, the short leg. If, for example, International Business Machines has performed way above VMware for no identifiable good reason, we would sell short IBM and go long shares of VMware, and we do that because these shares are very similar. They're co-integrated and highly correlated. They tend to have very similar betas. Therefore, and in order to keep your trading strategy easy and straightforward to manage, we like to use dollar-neutral pair trading instead of beta-neutral pair trading. And so, if we're going to buy long $10,000 worth of VMware, then we will concurrently sell short another $10,000 worth of international business machines. So we'll see that in a bit more detail on the next slide. So this is the last year. This is IBM versus VMware, the relative performance graph. If you start 1 year ago, you can see they're both at 0. And this is what their returns have been doing on a daily basis over the last year. Now, I would highlight that IBM and VMware, which are actually in our last top 50 USA stock pair stars, are correlated and they are co-integrated. So you see that when we say it's important to understand correlation and co-integration, correlation would mean that when one goes up, the other tends to go up. When one goes down, the other tends to go down. It doesn't necessarily mean that their relative performance will match. It just means that they move in a similar direction. So when we talked about a fish swimming outside of the school, what are its chances that it will rejoin the school? Well, if you consider these two moving together as being a school, if one swims way out, what are the chances it's going to go back to where it was? That is performing the same as our pair. That we can measure with something called co-integration. And we'll have more on that later in our series. But for now, let's just say that if a pair is co-integrated, it means that when the relative performance diverges, like here, it's likely that it will reconverge, like here. So when it gets to a certain level, which our software will measure for you and call signals for you to trade, you would, for example, in this pair, so VM is blue, IBM is green. You would sell short VMware at this point, let's say $10,000 worth, and you would buy long $10,000 worth of IBM. And you would exit that trade when the relative performance converges. And on this long position on IBM, you probably would have broken even, maybe a slight gain. But on your short of VM, you would have made a lot of money. And so that would have been a profitable pair trade. Here's another opportunity, very divergent relative performance. When it gets to that kind of extreme, you would short IBM in this case, go long, and close when that relative performance converges. The main benefit of pair trading that we really want to highlight so that you understand is that your exposure to market and sector risk is significantly reduced. That is hedged by holding both long and short positions in equal dollar amounts in a single or highly correlated set of market sectors. So here we have ticker MAS and ticker BECN. There's a trade called to buy long MAS and sell short BECN. So this pair trade was entered at $2,500 per leg sizing for a small retail account. 63 shares of MAS, 44 of BECN short. And what do you see? Well, over time, the market has moved up. So on MAS, you've made money, and on BECN, you've lost money because you're short. However, look at the P&L. You've made more money on a MAS than you've lost on BECN. And that differential, here it is, just $31. On a required initial margin of about $1,000, it's only 3%. Usually our trades come good at about 10 to 20% return on margin. But that difference in the relative performance going your way is what you look to capture as a profit in pair trading. But what you can see from this small example is that even though the market has risen by over 5% for these securities, MAS is up 5.41% and BECN is up also 5%. But there is a negative P&L on BECN because you have shorted it. What you see is that the actual combined P&L of the pair trade is not moving very much at all. It's very stable overall. So there's a $276 profit here. And if you'd just been short, you would have a $245 loss. But the net result is only about 31. And it's that net result going in our favor, which is what we're looking for. So you're protected from overall market moves and protected to a large extent in overall sector move. We trade stocks that are always in the same sector and almost always in the same industry subsector. So pair trading works because the relationship between two correlated and or co-integrated stocks is much more predictable and reliable than the outright prediction of the direction of a particular stock. It's very hard to know on any given day where the price of a security is going to be in 20, 30, 50, or 100 days. It's just very difficult to predict stocks. So we just jump over that and say we're not going to predict stocks. What we're going to predict is that, for example, two highly correlated and co-integrated securities, SPY, which is the S&P 500 ETF, and DIA, the Dow Jones Industrials ETF. You can see the correlation. When one moves up, the other moves up. When one moves down, the other moves down, but not perfectly. And so, here's a quick spread deviation analysis. When this distance between the price of SPY and DIA gets very far, as measured by this blue line, which you see here going through standard deviation lines, which are like Bollinger Bands around the moving average of the spread of the prices of SPY and DIA. When it gets really extended, we can just look at this visually here. They're very extended. You would buy long here and sell short here. And when they reconverge, you're going to make money because this difference has converged to zero. So you don't need to know whether the stock market's going to go up or whether it's going to go down. You don't care. You don't even care if it goes sideways. What you do care about is whether, because these two have stretched apart for some reason, that they are going to reconverge. And in this case, they did. And let's see. Here's a big divergence and a divergence here. And look, they reconverge here. So yes, they reconverge. And if you look historically, they always reconverge. So that's what you're looking to profit from with pair trading. You don't need to guess the direction of the market or the direction of a stock. You're just looking at the direction of the relationship between the two. So to recap, why do you want to pair trade stocks? So if you're worried about in the past or at the present moment, bad trading decisions, rising interest rates, inflation, recession, unemployment, stagflation, war, market volatility, investment earnings, a market crash, don't be worried about any of this. Instead, use stock pair trading to generate consistent monthly trading income. Hedge against market risk, sector risk, and a big account drawdown. We just showed you how to profit from market volatility, and we're going to have more on this later in this series. And, in general, how you can just stop worrying about Mr. Market. You're not trading the market, you're trading the convergence of the relative performance of co-integrated and correlated stocks. And we will show you in great detail how to do that simply and easily.